Elon tried to warn you. I'm your host, Steve Van Metre, and thanks for joining me today. And I want to get into our headline story about Elon's chilling warning to investors about their use of margin debt. Now, this is something I mentioned on Twitter the other day in reference to Elon borrowing against Tesla stock, which got a very interesting reaction. We've also got a report out of a British think tank about a recession coming next year, but what they're saying the recession is going to look like, well, it doesn't make sense. In fact, the data doesn't agree. And then we've got Putin calling for an end of the war. And what would that mean? And how would the markets react to that? Now, why does the headline story really matter here, particularly to Tesla investors? And why is Elon suddenly already worried a bit about margin debt? Now, as I mentioned in Twitter, when this gets really serious, you'll hear Elon screaming, because what happens, and this is very normal, particularly for CEOs of high-flying tech companies, is they'll borrow against their stock. Now, as long as the stock continues to go up, it's not a big deal. And in fact, because they're usually issuing themselves a large number of shares, or they're receiving a large number of shares for hitting certain targets, that it's not a problem for them to borrow against it and simply just pay the interest cost, and then they can use that borrowed money to finance their lifestyle. And that's typically what you see. But what happens when stock prices come down, and this is the same thing that happened with FTX in the crypto space, when prices come down, well, you start to get margin calls, and it's actually possible for CEOs to obliterate the stock of the company that made them rich. Let's go to Bloomberg, where we picked today's story up with Elon Musk warns against margin debt on the risk of market mass panic. And well, if it happens, he'll be having mass panic for sure. I would really advise people not to have margin debt in a volatile stock market. And from a cash standpoint, he says, keep powder dry. You can get some pretty extreme things happening in a down market. Now, what's interesting here is his mention, of course, of margin debt, which we know for the fact that he's borrowed against a large number of his shares, which we'll get into here in a little bit. But he's not the only one that does this. Investors commonly borrow against their stock and use it to buy more stock. And the problem happens when stock prices come down, investors get what is called a margin call. And when that happens, they either have to post more collateral, which in times of recessions they don't have, or they're forced to start selling their stock, and that can drive the stock price down even more, triggering another round of margin calls, and it can cycle and get out of control. And for Elon, well, that could obliterate his wealth and perhaps even destroy Tesla. The Tesla Inc. CEO put up billions of his own money when he purchased Twitter for $44 billion earlier this year and saddled the company with $13 billion in debt. Bloomberg News reported that bankers are considering replacing some of the high-interest debt he layered on Twitter with new margin loans backed by Tesla stock that he'd be personally responsible for repaying. And from the banker's perspective, perhaps you could have either ownership of a potentially worthless company. Maybe I'm not suggesting that Twitter would be completely worthless, but in the hands of the banks who would have no clue how to run it, it would become worthless. But give them shares of Tesla stock, which they could unload on the open market, and now they have a chance to get some of their money back. So you can see that this isn't just Elon borrowing money to fund his lifestyle, it's everybody wanting to hook their cart to those Tesla shares. The warning, at least the second made by Musk this month, is ironic given the billionaire's previously pledged his Tesla shares. As of December 2020, Musk had 92 million Tesla shares pledged as collateral, according to an SEC filing in April of 2022. And he tweeted, when there are macroeconomic risks, it is generally wise to avoid using margin loans on any company, he says, as stocks may move in ways that are decoupled from their long-term potential. And so you can almost see that he's referring to Tesla here, which we know is down more than 60% from its peak, suggesting that what he views as a stock that should be going up may actually go down more. And if it goes down too much, of course, we don't know his exact positionings because he doesn't have to disclose it, as you saw from Bloomberg. But if he gets to a point where he's a forced seller, well, he could be selling into a declining stock price, and that could snowball and cause Tesla stock to crash. But when we start to look at the bigger picture and you start to see that why markets crash during recessions, why we have bear markets, and one of the reasons is an extensive use of leverage. And here you can see on this next chart. Advisor Perspectives maintains this investor credit and the markets chart, and here you can see in red, this is the current level of margin debt. Now, it's way down from the peak where we saw the stock market peak, which is a good thing, but you can still see, compared back here to where we were at the peak of the great financial crisis heading into it, here we were at the peak before we hit the dot-com bubble, you can see that margin debt is excessive, and because of low interest rate policies by central banks, people have borrowed massively. But one of the issues we're going to see here as the Fed raises rates, well, that drives margin interest rates up too, meaning investors now have to pay even more money on their margin loans. So what they need is a stock market to go up and up a bunch. And if it doesn't happen, well, they either have to put cash in to cover that interest or again, sell stocks. But I want you to look back here one more time on this chart because there's something I want you to see, and that's this green. And after a big bear market, what you notice is investors go from having a massive amount of margin debt to a surplus of cash. So they go from one extreme to the other. So thinking about where we're at here and where we could be, well, that gets pretty interesting. And now you start to understand perhaps why Elon's so concerned, because if he does have 92 million shares he's borrowed against, well, you can see going back to just over a year ago, Tesla stock traded at 407, and there was no concern of this happening. But now at 123, we don't know where his margin call limit is. But as I mentioned before, and you see this in bull markets, particularly ones that are run by easy financial conditions supported by central banks, is the financial system builds up massive amounts of leverage, and eventually it goes bust. And you think about right now, we talk about the savings rate being near its all-time low. Where are investors going to get money to cover these margin calls should they happen? During the podcast, Musk also reiterated his belief that the economy is overdue for a recession and that the slowdown could be similar to the scale seen in 2009. Well, he better hope not, because if we get a washout of margin debt, who knows what that means for Tesla stock. My best guess is that we have stormy times for a year to a year and a half, and then dawn breaks roughly in Q2 2024. That's my best guess, Musk said. Booms don't last forever, but neither do recessions. And while history is on his side in that case, usually we see these booms actually turn into busts, and the bust cycle lasts somewhere between a year and a half. Historically, it's just the magnitude of the downside, which we've seen in the years past, can be huge. And of course, that would be a big risk to Tesla and his net worth, and perhaps even as other companies. Now, as we look at how the markets are reacting to this, one thing that we can look at is a CTA-Timer Pro report. Now, we're waiting on the programmer to finish adding the fast version of this. Many of you have jumped in on the $20 per month promotion. Again, the price is going to go up. But looking now, if you're wondering why the market isn't massively selling off despite Tesla stock dropping, you can see the machines are still posted around a 35% long position based on historic modeling. We see techs, NASDAQ, 55% short position, again, minus 55%. Looking over at bond market, we've seen them back off their long position there. And we're looking at the dollar perhaps reversing. If you want to get in on this report before all the price goes up, we'll have a guidebook that comes out with a new report coming soon. Again, $20, link in the description below for CTA-Timer Pro. And now let's talk about that British think tank who's got me confused about what they're calling as what a recession will look like. The world economy is headed for a recession in 2023, a researcher says, as high interest rates take a toll as inflation remains a threat. China is not forecast to pass the U.S. as the largest economy until 2036, and perhaps with what's going on with China, it's going to be a lot longer than that. It's likely that the world economy will face recession next year as a result of rises in interest rates in response to higher inflation, according to the director and head of forecasting at CEBR. The report added the battle against inflation is not won yet. And of course, as many of you know on the show, we've talked about how the leading indicators, and we're going to look at this in a moment, are telling us that the battle against inflation is coming to an end. We know it's coming, but of course, policymakers, researchers, they can't see it until it actually happens. We expect central banks to stick to their guns in 2023 despite the economic cost. The cost of bringing inflation down to a more comfortable level is poor growth outlook for a number of years to come, which is typically how this happens. You want to bring down inflation? Well, put people on the unemployment line. That tends to work really well in terms of driving consumption down. But let's tackle this view that central bankers are going to keep raising rates throughout next year, because the data shows, the market says, that's highly unlikely. And here we can see the federal funds rate in blue against the 10-year Treasury minus 3-month Treasury constant maturity yield curve. That's shown in red. And I'm going to make this a little bit easier. We'll invert one, but I want you to see how they're almost a mirror of each other. And where we see the inversion at this black line tends to match peaks in the federal funds rate. Now it's inverted, and here you can see the market suggests when you see that curve start to steepen and rates fall, it tells you it's leading indicator of where the federal funds rate is going to go. And we're starting to see some early indicators that the yield curve is rejecting the Fed's propaganda, their agenda here, and so we're starting to see rates head down. And what that means is the Fed, even though they're not meeting until February 1st, the market's saying, hey, we know, Powell, you're talking about raising rates. Well, what we're talking about is you pausing and maybe even cutting rates. And again, that's not in the central bank agenda. You're not hearing that in all these reports, but the market is saying that's what's likely to happen. Now, as far as inflation goes, well, we know the battle on that will soon be won. Because the same data point, the same yield curve, again shown inverted here in red against the consumer price index, you can see when the curve steepens, again shown inverted, so it's heading lower, leads inflation to the downside. And we see that happen in every instance when inflation gets too hot. And now we're again starting to see signs the yield curve is rolling over, and look what's already happened. We're seeing inflation coming down. So what that means is rates should continue to fall here and lead inflation lower. But what I want you to see in this report is what they're saying a recession will look like, because it doesn't make a whole lot of sense to me. The findings are more pessimistic than the latest forecast from the International Monetary Fund. That institution warned in October that more than a third of the world economy will contract, and there's a 25% chance of global GDP growing by less than 2% in 2023, which defines as a global recession. And what's interesting here, they're now saying, hey, if we get under 2% growth, that's a recession. Well, of course, we know the textbook definition is 2 quarters of negative growth, and what we're seeing already in the data, and we talked about this on a prior show, is the S&P Global Composite Purchasing Managers Index is a great leading indicator of GDP, and what it's telling us is fourth quarter is going to be negative, and if that carries over, we're not going to see 2% growth, we're going to potentially see negative growth, and that would be even more devastating than policymakers agree about. And now we have Putin claiming that Moscow ready for Ukraine talks as attacks go on. And of course, he notes that he's been ready to end the war and have talks. Of course, we can probably guess it means only if it ends on his terms, as it clearly Ukraine has been seeing continued attacks as a sign that peace is not imminent. But Putin said in a state television interview, excerpts which were released on Sunday, that Russia is, quote, prepared to negotiate some acceptable outcomes with all participants in this process. Now, from a market perspective, assuming that he holds good to this claim, and we can assume throughout history, at least through this conflict, that he is unlikely to unless he gets what he wants. But if the market believes it, look for stocks to rally here and say this is actually going to be good for growth. Look for interest rates to come down as a sign sign that inflation is going to continue to slow down as, of course, the oil problem now gets worked out as Russia maybe comes back into the market. But in terms of oil prices, I think they go down too. But what about gold? Because we've seen gold rise here during this conflict, but I'm going to give you a different look in terms of thinking gold goes lower. Remember, Russia has a lot of oil, and the U.S. needs a lot of it because we've drained our strategic petroleum reserve. Think about this. Do you think that Russia is going to take U.S. dollars for its oil? Not a chance, because the moment they get those dollars, you know that we can sanction them. But imagine this. What if Russia comes to the U.S. after the conflict is over and says, hey, look, we know you need oil and we need a whole bunch of money because our economy is tanking, and tell you what, we'll make a deal. We'll take gold. And if that happens, well, gold prices will skyrocket. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.